have here introduction, types of employee benefits. Types of employee benefits, that's IS 19, employee benefits. So we have here what they are calling, or rather IS 19 employee benefits identifies 4 types of employee benefit as follows. We have post-employment benefits. This normally relates to retirement benefits like pension, post-employment. We have short-term employee benefits. This includes now your like monthly or daily allowances here, salaries, all right? This includes wages and salaries, bonuses and other benefits. Of course, when you are employed, you get these things. Termination benefits arise when benefits become payable upon employment being terminated, either by the employer or by the employee accepting terms to have employment terminated. We have other long-term employee benefits. This comprises other items not within the above classifications and will include long service leave or awards, long-term disability benefits, and other long service year benefits. Ladies and gentlemen, what I would want us to look at right away is this. This is what I would want us to look at right away. Very, very important, and we were able to define this yesterday. Post-employment benefit plans. So of course, you're not writing anything here. I would just want you to take the page number of this book, because you have this book, remember, you have this book. So you can write their page number, post-employment benefit plans. You can write their page number 182, 183. So post-employment, after you retire, what happens? We talk about a pension. So a pension plan, sometimes called a post-employment benefit plan or a scheme, consists of a pool of assets together with a liability for pensions owed. A pool of assets together with a liability for pensions owed. Pension plan assets normally consist of investments, cash, and sometimes properties. The return earned on the assets is used to pay what year pay? Pensions. There are 2 types of pension plans. We have what we call defined contributions plan, and we have what we call defined benefits plan. Ladies and gentlemen, if you remember very well what we said yesterday, under defined contribution plans, these are benefit plans where the entity pays fixed contribution. The entity pays fixed contributions into a separate entity, and will have no legal or constructive obligation to pay further contribution if the fund does not hold sufficient year assets to pay all employees' benefits relating to their service. And I told you yesterday, if you remember very well, we said, ladies and gentlemen, and most of us really, this is the kind of pension schemes that we have at our workplaces. Most of us, these are the kind of pension schemes that we have, because normally what happens for, especially those of us who do not have some kind of private pension schemes. So what happens? Your employer remits your pension to the state through what here, the NSSF Act. So in this case here, we have your employer here who perhaps gives, like, say 10%, assuming you have a very good employer, 10% of your gross salary to NSSF. So in this case here, we have what we call a defined contribution. So your employer is simply contributing to NSSF, an external party. So there is a scheme, which of course is not being run by the employer. So this scheme is run by third parties there. Like NSSF now is a third party. So then what happens? If, for example, we as your employer provide these contributions here to NSSF, and then NSSF decides in this case here to misappropriate those particular resources, as an employer, I will not be liable when you're retiring. If you can't get that money, for example, from NSSF, your contributions, or rather your pension from NSSF, then you can't come back to me. For example, like now TSC, once a teacher retires, you will never get these teachers going back to TSC asking for pension. No, they're always moving along the corridors of what year? The corridors of NSSF. So in that case, then TSC is running what we call a defined contributions. It is the contributions that I'm supposed to be making, to be doing to NSSF, that both of us happens to be knowing, the employer and the employee. What happens in this case here with those contributions much later when you'll be picking your pension is none of my business. So we call that one a defined contribution. Ladies and gentlemen, On the other hand, we happen to be having institutions are really caring. They appreciate, in this case, the kind of work that you did for them during your youthful time. So in this case here, these good companies would want their employees to live life post-retirement, post-employment. They would want their employees to live a very good life. So in that case here, what do? They guarantee some form of benefit that would want that we are Kenya Airways, the pride of Africa, would want in this case here when our employees retire, they should be able to go home, say, with 20 million. And then every month, they should be getting like a pension, which is like, say, 60% of their current salary. So in that case here, they are guaranteeing some benefit. So when they are guaranteeing some benefit, we talk of a defined benefit scheme. So we've got two types of post-employment benefits. We have where we're doing a defined contribution, and we have where we are doing a defined OTR, a defined benefit. A defined benefit. Very, very important for us to be able to know exactly how to differentiate between those two terminologies from the word go. So we have here defined contribution plans are benefits plans. Benefit plans where the entity pays fixed contributions into a separate entity and will have no legal or constructive obligation to pay further contributions if the fund does not perform well. Now, defined benefit plans are post-employment plans that are not defined contribution plans. Now, ladies and gentlemen, the most important thing that you're supposed to appreciate here is how do we account for these plans? And I would want us to look at how we account for the defined accounting for the defined OTR benefits. How do we account for the defined benefit plan? So if you're writing your notes there, you'll have to book this page number. So this is page number 188, this one here. Page number 188, we are writing there, we have illustration number 1. So illustration number 1 is to enable us know how do we account for a defined benefit plan. How do we account for a defined benefit plan? You remember your examiner basically picks these questions from ACCA. It's an ACCA book, which all of us, we happen to be having this. So you're told here the following information is provided in relation to a defined benefit plan operated by Celine. At 1st January 20x4, the present value of the obligation here was 140. And the fair value of the plan assets amounted to 80. So they've given us a discount rate at the start of the year, current and past service cost, benefits paid, contributions into the plan, present value of obligation, and then we have fair value of plan assets like that. So they want us to determine the net plan obligation or asset as 31st December X4 and X5, and the amounts to be taken to the profit or loss and other comprehensive incomes for both financial years. This is very, very easy. Very, very easy. I'll be able to get all the marks here without even knowing what I'm doing. And I gave you a format. Remember, I gave you a format that you must always be remembering. I gave you a format that you must always be remembering. This is the format that I gave you guys. I gave you a format. Whenever you see defined benefit, I gave you guys a format. I gave you guys a format that you shall be using always. So this format goes like this: for defined benefit. For defined benefit, the format goes like this. So for defined benefit, this is what we said. Of course, we'll start with net obligation. Net obligation brought forward. So we have there our net obligation brought forward. All right. And then we come and add what here? We add interest earned or to be paid here. All right. So we have like that. Now, ladies and gentlemen, remember this is what has been brought forward. These employees are working for us. They are working for us. So as they work for us, what do we expect? We have what we call the service cost. So we have here current, so add current stroke what here? Past. Service cost. This decreases our obligation here. This increases our obligation here. This increases our obligation here. This increases our obligation here. So you add current stroke past service cost, very, very important. And then, ladies and gentlemen, you will come here. Of course, when it's an obligation, whenever we make contribution to the fund, we are making contribution to the fund, we shall come here and less what we call, in this case here, contributions paid to the fund, less contributions to the fund, to the scheme. You less this because now the obligation is going down. All right. And then now remember, please never forget this. Come and mention here, less benefits here, benefits paid here. However, for benefits paid, we say it shall always be zero. For benefits paid, it shall always be zero. And I'll be able to explain why. Whenever you're using what we call net obligations approach, this is what we call the net obligations approach, you shall not be subtracting any benefit. So basically, benefits paid will have to be forgetting about this. So these are the only 4 things that you bring on board whenever you're talking about what year, whenever you're talking about a pension scheme as per IAS 19. A pension scheme known as what year defined benefits. Then come and get your expected. Get what we call the expected. Expected what year? Expected net obligation. Expected net obligation. So this expected net obligation is what you will be able to compare with the actual net obligation carried forward at the end of the year. So you compare these two to be able to get what we call the remeasurement component, to be able to get what we call the remeasurement component. To be able to get what we call the remeasurement component, which is basically the old standard, and we can still continue calling this actuarial gain, or what year loss. That is what you shall do like that. Very, very important. So this is the format for a defined benefit scheme. For a defined benefit scheme, this will be the format. Once you guys finish putting down the format, are you able to put your thumbs up like this? Even if you were in our yesterday's class, it will be very important for you to have this format down. It will be very important for you to have this format down. Great, Selmith, great. So then if that is the case, ladies and gentlemen, let's now do this question pretty slowly, in a way that all of us should be able to understand. So we are told here, the following information is provided in relation to a defined benefit. The keywords there are a defined benefit. So it's a defined benefit scheme. So I have to follow this format, operated by a company called Saline. At 1st January 20X4. 1st January is when we were beginning, opening obligation there. At 1st January X4, the present value of the obligation was 140, and the fair value of the plan assets amounted to 80. So remember, we are talking of net obligation. When we talk of net obligation, you will take obligation minus assets. Never forget that. So please give us the net obligation as at X4. The net obligation as at X4. So the net obligation as at X4, this is what we are doing to get the net obligation at the beginning of X4. So we have here X4. I'll do this in columnar form because there are 2 years, X4 and X5. So we have here our net obligation brought forward. And we're saying that net obligation is obligation minus our assets. Remember, there is no way. It will be very hard. It will be very, very hard. It will be very, very hard to get a situation where in a pension scheme, normally pension schemes are net obligation schemes. In most cases, obligations will be higher, not unless you do lots of investments like what you have seen CBK doing. You know, like central bank, they have a very big asset base for their pensioners. Very big asset base for their pensioners. But in most cases, ladies and gentlemen, we expect the obligations here to be much higher. So always it shall be not net asset, net obligation. So you take the obligations minus what year? Minus the assets. And these guys have given us this figure. They have told us here that at the beginning of 2014, it is 140 obligation and then 80 assets. So then in that case here, we are beginning with 140 minus 80. We are beginning with a net obligation of what there? A net obligation of 60. Where did I get the net obligation from? So this net obligation, ladies and gentlemen, is here. This net obligation is here. You can see here, beginning of January 04, the present value of the obligation was 140, and the fair value of the plan assets here was 80. So 140 minus 80 is what we are putting down there as 60. Now, the moment I do that, ladies and gentlemen, this obligation I know now must earn interest. The obligation must earn interest. This obligation is like these guys have given us a loan, which will be, of course, in future, when we are paying these employees, we shall pay them whatever liability we had for them, plus any accrued interest. We must invest this money for them. So any obligations we have with them must always earn interest. So come and add interest here. So add interest here. So interest on this like loan here. And you've seen the interest rate of interest is 4%. So 4% of 60. Can somebody give me this 4% of 60? You can see where the 4% is coming from. The 4% is coming from here. My good students, the 4% is coming from here. You can see here, we have here discount at the start of the year 2014 is 4%. Is 4%. So is there somebody who is able to give me this 4% of 60 gives me what here? Gives me 2.4. Now, these ninjas, in the name of employees, they're working for us. They're serving us. As they serve us, their obligation to us increases. Because the more they serve us, the more the pension they accrue. The more the pension they accrue. So in this case, you're supposed to come here and add service cost. Add any service cost, whether previous or current. Add service what here? Add service cost. Add service cost. So the service cost that we have, ladies and gentlemen, here, the service cost that we have, you can see. Service cost, current and past service cost, you can write for the 2 years. We have 30 and 32. Write for the 2 years now. Everything now we shall be writing for the 2 years. So service cost is 30 and 32. So service cost is 30 and 32. 30 and 32 like that. Now, ladies and gentlemen, the moment I do this, I know now the last thing that I need to bring on the table here is the contributions. When we make contributions as an employer, when we make contributions to the fund, to the scheme, this obligation reduces. So come here and less the contributions made to the scheme, contributions made by the employer to the scheme here. So contributions made to the scheme, what do we have here? For contributions made to the scheme, this is what we have. So for contributions made to the scheme, they've given us here contributions made here, they're here. You can see contributions in the plan. We have 25 versus 30. You write like that, 25 versus 30, 25 versus 30. So in this case here, contributions, we have here 25. Of course, these are reducing the obligations. 30 like that. There are only 4 components. 4 components. And once in this case, we've been able to factor in the 4 components, so you shall come here and they give us what we call the expected net obligation, expected net obligation for only X4 first. For X4 first, is there somebody who can give me? Yeah, benefits paid. Great, I'll be able to answer that question. Benefits paid, we said benefits paid will never feature. If you're using the net obligations approach, benefits paid will never feature. We put a 0 there if you remember. If it's net obligation, you'll put a 0. Because benefits will be appearing, you know, when you pay benefits, what happens? Your assets, plan assets will go down and your obligation will go down at the same time. So they cancel. And I'll be able to prove that. They cancel. So I'm being given a figure of 67.2. 67.4. So this is the expected net obligation. But then what is the actual net obligation at the end? The actual net obligation carried forward. Net obligation carried forward. Actual net obligation carried forward. Is there somebody who is able to give me that figure from the book? The actual net obligation carried forward. The actual net obligation carried forward we are given here. We are given here. This actual net obligation we are given here. You can see at the end of the year for X4. For X4, what do we have there? We have 200 and we have 120. So 200 minus 120, that gives, because you see net obligation, I'm subtracting obligation minus what your assets. So as at the end of the year, it will be 200 minus 120. 200 minus 120, that gives me what year? That gives me 80. That gives me 80. That's for 2014. All the others now I also have to get the net obligation for 2015. Net obligation for 2015, we have here 230 and 140. So 230 and 140, can somebody give me this subtraction here? 230 minus 140, that gives me 90. That gives me 90. So here, ladies and gentlemen, I have 90. Here, I have 90 like that. I have 90, the actual net obligation. Now, please listen and listen to me very well. Come here and give me the actuarial loss. So give me the actuarial gain or loss. Here I have to write gain or loss because I've got 2 years. I don't know what will happen. So the loss will be in brackets, right? The loss will be in brackets. The loss will be in brackets. So we have here 67.4 minus 80. 67.4 minus 80 gives me, is it 12.6? Please use your calculator. Always we shall use our calculators. Always we shall use our calculators. So is this going to be a gain or a loss? Is it going to be a gain or a loss? Remember now here, this is a liability. Obligation is a liability which has increased. Ladies and gentlemen, when your liability is increased, you lose. You lose. So this is a loss. So it's a loss. So either you can put like, or you just write a loss down there. Now, ladies and gentlemen, remember this is the actual net obligation carried forward. Carried forward to which year? This 80. Carried forward to X5. So this 80 is what you put there. So go ahead in X5 and compute the interest. Do we have the rate of interest in this case here for X5? Do we have the rate of interest for X5? 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 Yes, it is 3%. 3%. 3%. So 3% of the opening obligation that you brought here. So 3% of 80. So 3% of 80, of course, this will be 2.4 as well. 2.4 as well. 2.4 as well. So then are you able to give me this expected net obligation here? Are you able to give me the expected net obligation? So how do we get this expected net obligation? We are taking the net obligation at the beginning, net obligation at the beginning, and then we have in this case here, you add the interest, you add the service cost, you subtract in this case here contributions made, and then we shall be able to get the net obligation, which gives us 84.4. I don't know whether these guys are following. 84.4, and you can see this is what we expected, but we have gotten a bigger figure. We've gotten a bigger figure. So when you get a bigger figure, it means that you are losing. It means you are losing. So somebody, what do we have here? So we have here 5 point what here? 5.6. 5.6 like that. 5.6 like that. So, and it is a loss, isn't it? So it is a loss. 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 I'll be showing you the statement of financial position extracts. But before I do that, there are students who like doing these things separately. There are students, can I wrap this? Can I wrap this? This is very, once you've done this, extracts are normally very easy to get. They're normally very easy. There are students who love doing this question this way. So they'll come and take 1 year. For example, we have here year X4. So for X4, they're going to do plan assets separate, plan assets separately, and then they do the plan obligations separately. So let's start with plan assets. Let's start with plan assets here. If you want us to do it this way, so here I'm not looking at the net now. So this is method 2. So this is method 2. Method 2. So we have here plan assets for X4 alone. For X4 alone. So these plan assets, ladies and gentlemen, I'll come and talk about what here are plan assets brought forward. Plan assets brought forward. So the plan assets brought forward, what do we have here? The plan assets brought forward, my friends, we are told here plan assets brought forward. Here they are. So now we are looking at only assets. So you can see here, brought forward is 1st January X4. Present value of obligation was 140. And the plan assets here were 80. So I'm only looking, I'm not netting off. I'm not netting off. So the plan assets in this case here, they are what here? Brought forward. They are 80 in X4. 80. So in this case, ladies and gentlemen, you'll come and add what here? You'll come and add interest. You'll come and add interest. So you'll come and add interest. So interest, 0.4, interest is at 4%, remember. So it is 4% of 80. Can somebody give me this figure? 4% of 80. So they're giving me a figure of 3.what here. They're giving me a figure of 3.2. Now from there, we as an employer, we send our contributions here. We send our contributions here. So the contribution will be growing the assets. So in this case here, add contributions. If you're using this approach, add contributions. So the contributions that are going to be added here, we've been given in X4. The contributions have been given. The contributions have been given. So contributions here will be 25. The contributions there will be 25. So you're adding contributions. So contributions of 25. All right. And then now if you're using this approach, when you pay benefits now, you must come and deduct here. So come and less benefits paid. Benefits paid. You're using this approach. Now the benefits must feature. Whenever you're separating, you have assets and liabilities by the side, then you must, in this case here, bring benefits that were paid here. I like that approach because like now the benefits paid will not feature anywhere. So we less the benefits paid, which will make our assets go down. Benefits paid, you can see here, in 20X4, they were 20. So in this case here, we come and less this 20. So these are the only things. Service cost cannot come here now, because service cost will be a component of liability. We will be liable to them, right? So then come and give me the expected assets here. Expected plan assets at the end. Expected plan assets. So we have here 80 plus 3.2 plus 25 minus 20. According to Selmith, we are getting 88.2. 88.2 like that. And then, ladies and gentlemen, you will come very fast here and compare these to the actual benefit. The actual benefit carried forward. Actual benefit carried forward. So the actual benefit carried forward, this has been given there. These are the actual benefits at the end of the year. The actual benefits at the end of the year. So the actual benefits at the end of the year. So the actual, not benefits, but assets. Direct benefit. No. It's actual assets, sorry. Actual assets. So actual assets at the end of the year, this one's here, 120. 120. At the end of the year, ladies and gentlemen, we have our actual assets being 120. Sorry for that. Change this. Actual assets. At the end of the year, 120. So then could you kindly compare the two? Compare the two for you to be able to give me the actuarial. Compare the two for you to be able to give me the actuarial gain or benefit or loss here. So like now in this case, this will be an actuarial benefit. Because these are assets and I can see our assets growing. These are our assets and I can see our assets growing. When assets grow, you gain. So Mary Ann is giving me a figure of 31.2. Mary Ann is giving me a figure of 31.2. 31.8. 31.8. Thank you very much. 31.8 like that. 31.8 like that. So then by the side, still 404, I'll come and do what we call the plan obligation here. So the two sides of the coin. So a plan obligation here for X4. Plan obligation for X4. So plan obligation for X4, ladies and gentlemen, we shall start with, in this case here, the plan obligation brought forward. So the plan obligation brought forward. So the plan obligation brought forward, what do we have here? Plan obligation brought forward, plan obligation brought forward, plan obligation brought forward, plan obligation brought forward, plan obligation, brought forward, we have here the present value, 04. The present value of the obligation that was brought forward here was 140. Was 140. So plan obligation brought forward is 140 here. What do you think will be the next thing to be brought here in this working? What do you think will be the next thing to be brought here? What other item should I bring here? Interest, yes. So we add interest here because this money is loaned to you. So add interest. So add interest. Remember, this is still 0.4. The rate of interest is 4%. So 4% of this 140. 4% of this 140. So can you kindly give me this 4% of the 140? 4% of the 140. So this gives me 5 point what here? Thank you so much. What other thing am I going to bring here? Somebody talk to me. This morning, this is your morning. Contribution, no. First of all, you think about service. These guys are serving us, you know. They're serving us. So when they serve us, the obligation goes up. So add the service cost. Add the service cost. So the service cost, ladies and gentlemen, in this case here has been given. The service cost has been given. The service cost has been given, both current and previous. So you add the service cost. Add the service cost. The service cost has been provided here. 20x4. It is what here? It is 30. 30. Service cost, current and past service cost, 30. So this is 30. 30. Thank you so much. Now, whenever you're doing this obligation by the side, obligation differently, the contributions you make will not affect this obligation directly. So you can't bring contributions made here. Here now what we're going to do is to come and less the benefits paid. We less the benefits paid. So you can see now benefits is appearing in both. That's why we said they should be able to cancel out. So benefits paid of what year? Of 20 like that. So then go ahead and give me the expected closing obligation. Expected closing obligation. 155 point what year? 155.6. So come and compare this with the actual closing obligation. End of the year closing obligation. End of the year closing obligation. Is there somebody who is able to see the end of the year closing obligation? End of the year closing obligation. So end of the year closing obligation, this has been given. End of the year closing obligation for X4. It is 200 here. It is 200 here. So this is 200 here. This is 200 here. 200 here. 200 there. So is there somebody who is able to give me the actual gain or loss? Actual gain or loss? Actual gain or loss? Actual gain or loss? So somebody is giving me a figure of 44.4. 44.4. Somebody is asking a question there. Thank you very much. Somebody is asking a question here. Okay, great. I need to answer something there. So Elizabeth Mkoba is asking, when this employee serves, remember you look at yourself as an employer now. When this employee serves regarding pension, what happens? The longer the service period, the more the pension will give them. Because, you know, this particular pension is accruing as this guy serve you. If they're not serving you, if they're not working in your company, then automatically you'll not be obliged to pay them any pension. If they work for you just for a month, then the pension you'll be giving them will be for that a month alone. So Elizabeth, I hope that is clear. The more the service cost, of course, the more the pension. And of course, as the pension then is growing, the more the liability. The more the liability. Yeah, thank you, Marianne. Great. So you're getting here 44 point what year? 44.6 like that. 44.6. So, and remember, this is liability increasing. When the liability increases, then automatically this becomes an actuarial loss. Actuarial loss. So in this case, ladies and gentlemen, then what is the net? The net actuarial. This will be a net actuarial loss because the loss is bigger. So the net, when you compare 404, what will be taken to your income statement, it will be this 31.8, this positive, all right, 31.8 positive minus 44.6. So you'll book in a loss of how much? 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 12.6. You'll book in a loss of 12.6. Is this figure familiar? Is there anybody who is able to remember this figure from the other method? Who they are not able to see that figure? We had gotten this figure from the other method. Yeah. Yeah. So Mary Ann, I hope I've answered you. Now you are able to see, like, why were we forgetting the benefit? Benefit paid will appear in both. If you're using the net obligations approach, then automatically this is how you shall do it. This is how you shall always do it. This is how you shall always do it. Now, ladies and gentlemen, it is now our turn to do things. Let's get our past papers. Before I show you how we post this, the income statements, and to the statement of financial position, let's get out our past papers. We do things here. Just a minute. 1 minute. I want to do something very nice here from our past papers. Power my machine. All right. So this is the question that I would want us to get here. I hope, Paul, they are in the group and they'll be able to send this question pretty fast to ourselves here. Yes. May 2019, question 3A, Roman 2. May 2019, May 2019, question 3A, Roman 2. May 2019, May 2019, question number 3A, Roman 2. Once we get that, then we'll have really made very good ground on this concept of what here? Pension. IAS 19. So once you get the question, Paul has been able to share it here. Paul is normally quite fast. May 2019, question number 3A. Question number 3A, Roman 2. So now I hope everybody has access to this question. Let's tackle it. Let's tackle this question slowly. Early morning class hatuna haraka. Problem ya early morning class wengi, saa zingine sijui wanafanya namna gani, wanakuja class late. Ukija class late, class ya AFR, you miss a lot. You miss a lot. Kama kuna class nafaa uingie tu just on time, it is AFR. The moment you get yourself being late like for 5 minutes, you would rather not come. Uangalie video later. So ukiona unaenda kuchelewa kidogo, vuta blanketi kabisa kabisa. Ala kabisa, uangalie video later. Although, of course, the more the videos you'll be having to watch, the most difficult time will be getting later. So now we have gotten this question. We are reading it, all of us. We are told W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligation as at 1st January 2018 was 38 million, and the fair value of the plan assets as at that date were 2860 million. Further information relating to the pension plan for the year ended 31st December 2018 was as follows. So you can see current service costs. We can see benefits paid to former employees, contributions paid into the plan, present value of a benefit obligation as at that date, fair value of plan assets as at that date. Additional information, we are told, interest cost, gross yield on blue chip corporate bonds is at 5%. On 1st January 2018, the pension plan was amended to provide enhanced benefits with effect from that date. The present value of the enhanced benefits as at this date were given there. The required notes, the statement of comprehensive is what they want us to do. So, ladies and gentlemen, then if you are given this kind of a question in an exam, what would you do? So I would want you to take 2 minutes and try, ladies and gentlemen, to tackle this question. And I would want to do this question using the net obligation approach. So I'm giving you exactly 3 minutes. We see how far away you can go with it. Net obligations approach. Imagine it's a very easy thing. These are very easy thing. I'll get all the marks even without knowing what I'm doing. Net obligations approach. So within 5 minutes, what will these ninjas really write down? Imagine andika tu, so long as umeandika tu, ukiandika tu jina net obligation brought forward. Hapo ku subtract. Very easy. This is very easy. Thank you for trying. Let me do it. Let me do it. Let me do this. Now, ladies and gentlemen, we're using the net obligations approach where we combine obligations and plan assets on the same working. It makes our life very easy. But unfortunately, you will not be able to say that that's the best method which you will be able to just master alone. No. Your examiner at times just tells you to do a plan assets account. So even the other method, you must still get to know it. So we start with net obligations here. So our net obligations here. Net obligations approach. So remember, these are obligations minus assets. Okay, so then we are doing for, it's just 1 year. So we have here net obligation brought forward. So net obligation brought forward, I'm able to see somebody's getting 66 there. So I'm able to see, ladies and gentlemen, here, the net obligation brought forward, what am I able to see here? the net obligation brought forward, what am I able to see here? What I'm able to see here, ladies and gentlemen, as the net obligation brought forward, I can see on the very first paragraph, they have given me the present value of the future benefit obligation as at the beginning, 2018. It is 3080. So it is 3080 minus the plan assets brought forward on the same date, which were 2860. So you guys able to give me that figure? EDA gives me 220. So of course, this will earn interest, but you must be very careful here. Add interest here. Add interest. So what is the rate of interest given? The rate of interest given, note 1, is 5%. Note 1 is 5%. But you have to be very careful here because of what here, something that has been provided. So add interest, leave it out like that. Just leave it out like that. What else are we going to add here? What else are we going to add here? We are going to add here current service cost, because I can see them. Current service cost. So the current service cost hapa ni pesa ngapi uye? Current service cost 209, right? The current service cost in 209. 209. Current service cost in 209. Kwa hii question, iko na past service cost. Iko na past service cost given separately, and this past service cost was given at the beginning of the year, 1st January 2018. 1st January 2018. So on 1st January, as per note number 2, we looked back and we said, no, these employees who had toiled for many years for us in the past, they retired, whatever, we have to adjust their benefit. So we're adjusting benefit for these employees for the past service that they did for us. Note 2, on 1st January 2018, the pension plan was amended to provide enhanced benefits with effect from that date. The present value of the enhanced benefits as at that date was calculated by actuaries at 110. At 110. 110. 110. Now please listen. Whenever we have this past service cost review being done at the beginning of the year, normally it has to attract interest. So it will be lumped together with this obligation at the beginning when you're calculating interest alone. So the interest here will be 220 plus this 110, plus this 110, like that, times this 5%. So for past service costs, you have to be very, very careful. Whenever you're told that this past service costs review was done at the beginning of the year, like now this 1st January 2018, then they must be put together with the opening obligation, net obligation there for calculations of your interest. Nowadays, normally the past service cost will be done at the end of the year, at the end of this current year. So like now, for example, you're in 2024. So at the end of the year is when you call the actuary. So they'll be able to come and tell you all the past service costs at the end of the year. They are what year? 110. So if this figure was given to us at the end of the year, it doesn't accrue interest. It doesn't accrue interest. The moment I get this, the earlier I get this, the better. So I'm being given a figure of 16 point what year? A figure of 16.5. A figure of 16.5. The interest is 16.5. All right. So then what else do we bring here? Can somebody tell me? What else do we bring here? What else do we bring here? Contributions. Contributions, yes. Because it is a net obligations approach, so it shall come here unless contributions made. Contributions made. Over how much? Contributions made over how much? Contributions paid into the plan over how much? 242. Is it 242 really? 259. 259. Good question there. Why should we subtract 259? Remember, this is an obligation. So when we have an obligation and we are generating this, we are taking, in this case here, this asset there, this contribution, and making a contribution there. So we expect, in this case here, the obligation to reduce. We expect the obligation to reduce. And that is it. So please go ahead and give Mwalimu here the expected net obligation here. Expected net obligation. What happens to the benefits paid? Can somebody tell us what happens to the benefits paid? What happens to the benefits paid? Benefits paid, whenever you're using this net obligation approach, benefits paid nakuwa ni hot air. Yeah, cancels out, ignore. Whenever I'm using, in this case here, net obligations approach, we shall always ignore the benefits paid. So please go ahead and give me this expected net obligation. Go ahead and give me this expected net obligation. So it is 296.5 according to cell me here. 296.5. And then very fast, I'll be able to come here and compare this with the actual obligation carried forward. So compare this with the actual obligation carried forward. So the actual obligation carried forward, great. Thank you very much, Daniel. So the actual obligation carried forward, if you look at this thing very well, and remember it has to be net. Sorry, here, it has to be net because it's net obligation here. Remember, net obligation means you take obligation minus assets. You take obligation minus assets. You take obligation minus assets. So the net here will be 3360 minus 3113. 3360 minus 3113, which will end up giving us what figure, ladies and gentlemen, here? 247, I'm told. 247, I'm told. 247. Thank you so much. So then at the end of the day, we are going to have an actuarial remeasurement component, which will be an actuarial gain. Gain, why? Because the benefit has reduced. We expected the benefit, not benefit, but obligation to be up there. We expected this obligation to be up there, and this obligation has come down. So we're gaining here. We are gaining by how much? Can somebody give me this figure? We are gaining by how much here? We are gaining by 49.5. We are gaining there by 49.5. We are gaining there by 49.5. We are getting there by 49.5. So I would want you guys to do Mwalimu a favor. Please do me a favor. Now I want you to use the second method. I would want you to use the second method and see whether you'll be able to get this actual gain of 49.5, and then I buy you a small soda. Second method. So second method is where you are putting the plan assets by the side and the plan liabilities by the side. Second, we must be good in the two methods. So if I were you, I'll not even panic at all. I'll just write somewhere there, plan assets. So I do blah, 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 and then plan liability. So I'm giving you exactly 5 minutes. You try this out. Have you writing something? I hope they're writing something. Yeah, the same question, Tekla. This May 2019, but now using method 2. We're using method 2, where we do the plan assets. We don't combine. We do plan assets by the side, and plan obligations by the side separately. Hmm? So 93, 16, I can see answers here. Great. Thank you very much for trying. I can see Patrick, plan assets 197.5. You know, trying is the most important thing. In this level, this paper wants you to try. Even if you get it wrong, so what? Plan assets I'm being given 93. Marianne, plan assets 93. I'm waiting for three more contributions. Obligation 49. Okay, let's see, ladies and gentlemen here. Thank you so much. Thank you so much. Let's see. Let's work this out together. Very easy. Very easy. Nothing really here. Nothing really here. So, ladies and gentlemen, this is what they have given us. This is what they have given us in terms of plan assets. So in terms of the plan assets, what do we have here? So in terms of the plan assets, this is what we have. Plan assets. So plan assets, you talk over plan assets brought forward. So plan assets brought forward, what do we have here for plan assets brought forward, ladies and gentlemen? Just walk me through this very fast. Plan assets brought forward. Are you able to see the plan assets brought forward? Wait, they're not even talking to me. They are not even talking to me, these ninjas. So plan assets, what do we have there? 2860, yes, 2860. So once you have these plan assets there as 2860, straight away we shall add interest income. So you add interest. Interest, what is the percentage? 5% times 2860, which gave you guys what figure? Being given 143. 143. Ladies and gentlemen, please, whenever you're looking at assets here by the side, never add anything to do with service. Because when these guys are serving you, it's not assets going up, it's obligation going up. So here we shall only come and add assets coming into the plan. So add contributions. Contributions received over how much? How much contributions have we received here? How much contributions have we received? 259, isn't it? So we have here 259. Thank you very much. Now from there, ladies and gentlemen, you'll be able to come here and of course now benefits you're paying. The benefits you're paying. So less benefits paid because now they become relevant. When I'm looking at assets in isolation, they become relevant. So less benefits paid to former employees of 200 what year, and that is it. So give us the expected assets. Expected plan assets. So you add everything and then subtract 243. So I'm being given a figure of 3020. A figure of 3020. So then I'll be able to come and compare this with the actual benefits. Actual benefits. Not benefits, but plan assets. Carried forward. Carried forward. So carried forward. So the actual, are you able to see the closing? Are you able to see the closing, the actual? They're supposed to be what here? Somebody 31? 30. 31, 30. So then you will be able to see here that the assets have grown. When the assets grow, here they were supposed to be 30-20, but now they're 31-13. When they grow, then we have gained. So we have what we call an actuarial gain. An actual gain of how much? 93. An actual gain of 93, like that. Actual gain of 93. 93. And I saw so many of us were able to get this. And the few guys who never got this correctly, you must have now seen where you went wrong. I'm so sure where most of us went wrong is in this benefit. Most of us must have said benefits, 0. The concept of benefits being 0 only comes whenever we are getting a net obligation. We are using net obligation approach. Belinda is way ahead. So with your permission, I will wrap this so that I can now look at the plan what year. I can look at the plan obligation. All right. So plan obligation. So the plan obligation, what do we have here? And obligations, pretty similar, but now you have to bring on board what we call what here, what we call the service costs. So obligation. So the plan obligations there. So plan obligations start by giving us the opening obligation here. Give us the opening obligation. So the opening obligation, ladies and gentlemen, what do we have here? Opening obligation. These guys are able to give me the opening obligation pretty fast. From that paragraph, the first paragraph, from the first paragraph, what do we have as our opening obligation? 3080. Pamela, I've seen your question. I'll be able to answer right now. So 3080. So this obligation, we must add interest. But before you add interest, remember you're going to bring in the concept of service. So it'll be 5%. 5% fine, but don't multiply with this first. So come and add service. So service cost, I can see the current service cost is how much? Is 209. Current service cost is 209, isn't it? The current service cost is 209, plus in this case here, the past service cost of 110. So is there somebody who can give me this total service cost? 209 plus 110? 209 plus 110. You can decide to put them together. That is past and current. You can decide to put them together, past and current. Past and current. Yeah, 319. But now remember that this service, past service cost was done. The review was done at the beginning of the year. So it means it must form part of the interest. So it will be 5% times 3080 plus 110. 3080 plus 110. Yeah, so this interest gives me 159 point what here? 159.5. 159.5. Ladies and gentlemen, once you have that, really, now everything becomes very easy. So you'll be able to come and less the benefits. Remember now I'm looking at obligations only. So the benefits we paid would reduce the obligation. So the benefit we paid, this gives us what here, benefit paid gives us what here, somebody benefit that we paid. Is there somebody who can see the benefits we paid were 243? 243. So now that is everything. So come and give me the expected obligation. Give me the expected obligation. Give me the expected obligation. 33, 16.5. 33, 16.5. They are saying it's 242, not 243. Thank you very much. It's 242. Thank you very much. That is the expected obligation. And then how about in this case here, the actual obligation carried forward to next year. Obligation carried forward to next year. Actual obligation carried forward to next year. Actual obligation carried forward to next year. You're able to see that figure, that 360. That 360. So Pamela, if you look at this, now this is an obligation and liability. You can see initially it was supposed to be at 316, but now it has grown to that 360. When a liability grows, Pamela, you lose. You lose. So then this becomes, in this case here, an actuarial loss. Actuarial loss of how much? Or they're calling it gain. Is it gain or a loss? Pata potea. Remember here, it is not unless I got this figure wrong. If it's at 316 and at 360, when your obligation grows, when your obligation grows, you make a loss. When your obligation grows, you make a loss. So this is 43.5. When your obligation grows, you make a loss. And therefore, the total actuarial loss will be equal to what here, somebody? So I should take something from their side. Are they able to remember what we got for our assets? Are they able to remember what we got for our assets? 93 minus this 43.5. So that seems to be an actuarial gain. It will be a net actuarial gain. It will be a net actuarial gain because the gain is more. So at the end of the day, this becomes a gain of what year? A gain of 49.5. A gain of 49.5. Remember, when assets grow, you gain. When liabilities grow, you lose. You lose. So I hope that is a bit clear. I hope that's a bit clear. And now it can help us do a few things here and there. All right. So now a speed test, ladies and gentlemen, a speed test. Speed test. So this speed test, I would want us to look at this question. Speed test. Just a minute. So speed test, speed test. Test your understanding. Great. Let's test your understanding 3. Yes, this one here, test your understanding 3, Fraser. Fraser. So you have to write the page number because of your revision here. So which page number is this really? It's 191. 191. Page number 191. So the following information relates to a defined benefit plan operated by Fraser. At 1st January X1, the present value of the obligation was $1 million and the fair value of the plan asset was 900,000. All right. So then they have given us so much. So they want us to show how the defined benefit plan will be shown in the financial statements in the event that this examiner does not give us the method to use. We shall always use the net obligation method. Net obligation. And I want you to combine all the 3 years. I want you to combine all the 3 years. You do it the way it is, X1, X2, X3. So I'm giving you exactly 5 minutes. We see what you guys will be able to do in this question. Very easy. So of course, all those students in this case here would want to do AFR. Today was a free of charge class. That's why I can see we have a very big number, 85 is very, very good. I would want to welcome all of you to join RCM. RCM, of course, we have early morning classes, evening classes, being taught by very competent teachers. You just get to choose your program and you cannot go wrong. This book, remember, also has got answers at the back. Answers at the back. It's a speed test. So this book is the ACCA book which you have. Mary Ann can share it in the WhatsApp. Mary Ann be sharing in the WhatsApp. Be sharing in the WhatsApp group. You need this book. It's very, very practical. Hakuna mwanafunzi mmoja amepata actual gain or loss? Because when they tell you to account for this, they simply want you to give us actual gain, actual loss.
Yeah.
So I can see one chart here. Loss of 5, x1. Pata potea. Let's see. Oh, actually loss of 5, x1. We can compare notes here. The answer is here. So in this case here, you're right, because you can see here the remeasurement component. Yeah, you can see like the loss is supposed to be positive for them here, balancing figure. So here we have 5, 9, 88. So thank you very much, ladies and gentlemen. It's almost 6:30. I'm so sure each one of us will be able to finish this. And then we get to share our answers as usual on WhatsApp. It has been a pleasure hosting you in the morning. Bye. Bye. I hope you've gotten something. Thank you so much. Have a great day, Mike, and everyone here. Bye.